Welcome to the deep dive. Today we're jumping into, well, a really fascinating economic puzzle. One that played out from, 2020 to mid-2025.
That's right. It's quite the head scratcher.
You had the U.S. tech job market going through this wild boom and bust, like a real roller coaster ride.
Very dramatic swings.
But then, and this is the really interesting part, during that exact same period, the overall national unemployment rate, it stayed remarkably low.
Incredibly stable, yeah.
Uh.
Hovering near 50-year lows for a lot of that time.
So how could these two, totally different realities exist side by side? That's what we're going to try and unpack today. This tale of two labor markets.
It's striking, isn't it? Because tech is often seen as, the leader, the bellwether for the whole economy.
Exactly.
But here, it clearly decoupled from the broader job market. Really makes you question some assumptions.
Okay, so let's dig in. First up, the tech sector's wild ride. The boom phase, say 2020 to mid-2022, it was a perfect storm, wasn't it?
Absolutely. You had the pandemic hitting, which basically acted like a giant digital accelerator.
Right. Everything went online overnight.
Yeah, remote work became standard. E-commerce just exploded, growing, 2 to 5 times faster than before?
Wow.
And telehealth visits shot up like 50% in 2020. All this created this sudden massive demand for tech stuff and tech workers.
And at the same time, you had this era of free money, people called it.
The Fed slashed interest rates down to basically zero.
Which flooded the market with capital looking for growth.
Precisely. And that pushed investors hard into high-growth tech.
Sure.
Venture capital funding globally hit a record, I think it was $669 billion in 2021.
$669 billion. That's huge.
It fueled this sort of growth at all costs mentality.
Yeah, hire everyone now, figure it out.
Pretty much.
Yeah.
Some called overzealous hiring. Software job postings, they track this stuff. The index hit 230 by early 2022. That's like a 280% increase from before the pandemic.
Just incredible pressure to hire.
But then the wheels came off. Mid-2022 through 2024, the bus hits.
And the trigger was inflation.
Yeah, 40-year high inflation.
Yeah.
So the Federal Reserve stepped in and started aggressively tightening monetary policy, meaning big interest rate hikes.
Right. They went from near zero.
All the way up to 5.25 to 5.50% by July 2023.
Okay, that's a massive swing. And how did that directly hit tech?
Well, higher interest rates basically crush the value of future earnings. And so much of tech valuation is based on promises of profit way down the line.
Ah, okay. So future money is worth less today when rates are high.
Exactly. So tech valuations plummeted, and that VC funding, it fell off a cliff, dropped around 30% annually.
30%? Ouch!
So companies had to slam the brakes, pivot hard from growth to efficiency, cost-cutting.
Which meant layoffs, mass layoffs.
Huge numbers. Over 264,000 tech workers laid off in 2023 alone. You saw it at Google, 12,000 jobs cut. Amazon, over 27,000. Meta, 11,000.
Just staggering figures. And those software job postings
Plummeted. Down 70% from their peak by mid-2023. Ended up way below even pre-pandemic levels. It shows how sensitive tech was, maybe surprisingly so, to the cost of capital.
A real wake-up call about tech exceptionalism, maybe?
Absolutely. But here's where the story gets even more complex. The resilient rest of the economy.
Right. While all this tech turmoil was happening,
The national unemployment rate, mid-2022 through mid-2025, just stayed incredibly stable, bouncing between, 3.5% and 4.2%?
near 50-year lows. It's like two different economies operating.
It really was. And why? Well, partly because many non-tech sectors were still just recovering from the pandemic. They weren't correcting from some speculative bubble like tech was.
Okay, that makes sense. And there was that labor hoarding idea, too.
Yeah. Businesses outside tech had struggled so much to find workers, they were really reluctant to let anyone go, even if things slowed a bit.
Didn't want to get caught short-staffed again.
Exactly. Plus, you had really strong job creation in some key non-tech areas.
Yeah.
These acted like powerful engines keeping things going.
Like what sort of areas?
Healthcare and social assistance was a big one, adding 55,000 jobs a month in 2023, driven by, the aging population.
You're right.
Government jobs also came back strong, adding 56,000 a month as public services ramped up again.
Right.
And leisure and hospitality, still recovering from the pandemic hit, added about 39,000 jobs a month.
So these jobs, nurses, government workers, servers, they're driven more by immediate demand, less tied to investment capital and interest rates.
Precisely.
Yeah.
They're much less sensitive to those big Fed rate hikes than, say, a software startup dependent on VC money. That really buffered the overall economy.
Okay, so that explains the resilience, but where does that leave us now? Tech hiring hasn't really bounced back strongly between 2024 and mid-2025.
No, it hasn't, which suggests this isn't just a cyclical downturn for tech. It looks more like a deeper structural shift.
Hmm.
And a big part of that seems to be AI. We're calling this the new paradigm, AI's structural shift.
AI, right. It's everywhere now. How is it impacting jobs?
Well, it seems to be a dual force. On one hand, it's a bit of a job destroyer for certain routine tasks.
Uh-huh.
We're seeing a big drop in entry-level tech hiring, maybe over 50% down. And even traditional mid-level coding jobs like Android or Java development, those postings are down over 60%. AI is automating some of that work.
Okay, so displacing some existing roles, but it's also creating new ones.
Yes, definitely. It's creating intense demand for specialized AI skills. Machine learning engineer postings, for instance, are still way up, like 59% above early 2020 levels.
Wow.
And you're seeing completely new roles pop up, like prompt engineer, people who are good at telling AI what to do.
And these AI skills command a premium, I bet.
Oh, yeah. Workers with the right AI skills can earn up to 56% more. So capital and talent are shifting, reallocating towards AI.
Mm.
We're even seeing experienced tech people moving into non-tech industries like finance or healthcare, bringing those AI skills with them.
Okay, so wrapping this up, what are the key takeaways from this whole deep dive?
I think there are three big ones. First, maybe the end of tech exceptionalism. The tech sector, well, it turns out it's not immune to basic economics. It really cares about the cost of capital.
Right, lesson learned there.
Second, it truly was a tale of two economies. The U.S. labor market isn't just one single thing. Those demand-driven non-tech sectors really saved the day overall.
Yeah, they provided a crucial buffer.
And finally, what we're seeing now feels like the great skill reset. It's not just a temporary dip, it's a fundamental mismatch between the skills companies needed yesterday and the new AI-driven skills they need today and tomorrow.
That's a really important point. The ground is shifting under our feet. Which leads to a final thought for you, the listener. As AI keeps blurring the lines between tech jobs and non-tech jobs, because AI is going everywhere, what new skills will you need? How will you adapt to keep pace with this constantly changing economic reality? Something to think about.